In today's Private Market Pulse Snapshot, the one thing I'm focused on is this: the value proposition of private equity, especially in the world of higher interest rates. Private equity is the single largest asset class within alternatives. It has $5.9 trillion in assets under management as of the third quarter of 23, and that is still forecast to grow at a 7% annual rate that should reach $8.5 trillion in AUM by 2028. So what is driving this continued growth in private equity? Well, first of all, it's the opportunity set for investors. For example, there are about 11,000 private equity-backed private companies versus just 4,600 public companies listed in the United States. That ratio is 2.4 times, and that has skyrocketed since 2008. And private companies account for 64% of all companies with revenues between 100 million to 500 million. They also account for 84% of companies that have revenues over that $100 million threshold. Now, the reason for such great private company percentage is that fewer companies are going public today relative to the late 1990s. On average, since 2000, there have been 127 IPOs each year versus 307 IPOs on average between 1980 and 1999. This year in particular has been another very slow year of IPO activity, with the number of public listings just slightly higher than last year, and last year was amongst the lowest on record in terms of IPO activity. As companies are staying private longer, the median age of the IPO has risen from 8 years in 1980 to 1999 to average 11 years since 2000. So what does this mean? Well, it means that when companies do IPO, they're likely more mature and their revenues or earnings growth rate is slower than during the time when they were still private. Indeed, the median market value of companies at IPO has risen sharply over the past 2 decades. Now, this in turn means that the returns to investors were likely higher if they invested before the IPO than after it. Indeed, one study shows that the annualized returns 6 months after the IPO were just 2% if the investor purchased the stock at the IPO open trade price. Now compare that to the 40% if they purchased at the IPO offer price, but that is still lower than the 55% annualized return if they entered as a Series C or D investor. So the first reason for private equity growth is this opportunity set. And the second one, which we just talked about, is this value creation in private markets that has been helping private equity managers outperform public markets. But some still question, can this value creation continue in private equity despite higher interest rates? Well, we do find reasons why it could. Take a look, for example, at the breakdown of the GP value creation. There are multiple ways in which private equity managers create value: by buying at a cheap multiple and then selling at a more expensive one, or by applying cheap financial leverage and other financial engineering, or, of course, by operational improvements. Now, it is fair to say that buying low and selling high may not be as lucrative today, given today's higher multiples, and also no more cheap money available that could be fueling those valuations. And of course, applying cheap leverage is also no longer an option, given that 5% interest rates might be here to stay, at least for now. But the focus on operational improvement, using the expert knowledge and know-how to grow revenues and earnings above public companies, that should continue. That should continue to be the value generator for most experienced and skilled managers. Indeed, private equity-backed companies historically delivered higher EBITDA growth rates and higher EBITDA margins than the Russell 2500 counterparts. And typically, that operational improvement accounted for a large portion of aggregate value creation. All in, we do find compelling reasons to believe that growth and performance in private equity will continue. And if history is any guide, skilled private equity managers manage to outperform during a variety of interest rate environments. The focus for investors should be on finding managers with the right mix of skill, experience, and consistency of track record. And that's your one thing in private markets this week.